Y'all hear me?
Yes, we can hear you. Or at
Okay,
least I
thank you.
can.
Yep, thank you, Anna. Yeah, I thought I'd come on a few minutes early. I'm not going to keep y'all the whole hour today, so there's a lot going on here. We I got a call last night. So the house that my son lived in before he passed, my husband and I, or my husband, his daddy and I have co-ownership of it now. And he called me last night. They'd had a fire, so took out most of the kitchen, so it's uninhabitable. So I had to go over to Greenville and get them and brought them back here. Them and their two big old dogs. So if you hear barking, that's what it is. But the Red Cross just left, and anyway, I think they're probably just gonna stay here with me until we got to get with the insurance company and everything. But it was an interesting evening to say the least. So I called Dr. Willis and said, I just didn't want to go far away from them because remember I'm an hour away from Greenwood, and I hated to go off and leave them. They're here. I hated to go off and leave them by themselves because we're dealing with the insurance company and everything else. So I'm trying to help them navigate through this. So anyway, I do apologize for the inconvenience. Y'all see why I tell you to check your check your emails and announcements, right? You just never know when something's going to happen. So anyway, all right, well, let's see. How many have we got? We've got 16 of you so far. Okay. Um, so that's good. So I'm going to go ahead and get started. Like I said, I'm not going to keep you the whole hour. I do appreciate you coming on. Like I said in the announcement, Zoom records attendance for me, and if you're on with somebody, like if you're in a dorm together or whatever, and you're doing it together, just send me an email and let me know y'all were together, and I'll mark you present. I'm watching. People are still coming in, so um, all right. I'll keep watching that. In the meantime, I am going to go here, and I'm going to share my screen. I think. Hold on, let me get to the right place here. There's what I want right there. Okay. So, all right. So I think it'll flag me if somebody comes in. Slideshow. Yep, there we go. Slideshow and from beginning. Okay. All right. So yeah, I think it'll flash me up. Can y'all see my screen?
Yes.
Okay, very good. Thank you. All right. So basically, what we're gonna do. Let's see. I got some. I'll be watching the chat too. So
Dr. Horn, it seems that it's frozen for a lot of us.
Can y'all hear me now?
Yes, and we can see your
Okay.
screen.
I am so sorry. Darn internet. What can I say? All right. Let's try this again. I think I was telling you about I'd never heard the first day of class called syllabus day, and I passed a colleague on the way to the car yesterday and they said, "Oh, what it was a good day for syllabus day." And I'm like, "Are you serious? I've never heard that before in my life and now I hear it twice in one day." So so that was really weird. So, you're never too old to learn. So that's my attitude. Never too old to learn. Okay, so we're going to try this again. Hopefully now you can see my screen. If you can't see my PowerPoint, just type it in the chat or shout at me and let me know. Um, so I just kind of wanted to go over what's involved in the chapter. It's kind of divided up into two parts, Part A and Part B. Part A is probably going to be mostly a refresher for you guys. There are some new things to learn in there that you probably did not learn in financial accounting. And then Part B, you probably didn't touch on contingencies at all in financial accounting. If you did, it was probably very brief. And so, but that's something as an accountant that you really need to be aware of because those contingencies are actually I'm sure you're going to be tested on the CPA exam about those. So you need to understand those, what they are and how they're recorded and all that good stuff. So today I'm going to try to just kind of give you just a quick refresher. We'll get that out of the way, and I'll probably stop when we get to accrued liabilities, okay? And that's okay because we're fine. We're not going to get behind. I'm not going to let that happen to us, okay? And so like I said, this is kind of going to be a refresher for you, about liabilities. And so, just to kind of think about what are liabilities. So before a business can invest in an asset, it has to have the money to pay for it, right? Same thing with us, right? Before we can buy something, we got to have the money to pay for it. So you can either pay for it with funds that you have, like cash, or you have to go borrow it. Okay, and so there's good and bad things. There's the good, the bad, and the ugly, and so there's good, bad, and ugly with either way. And so that's what you're going to further your knowledge about in this class. We talked a little bit briefly about, when a company issues notes or bonds, then the creditor is the bank or the individuals who invest in the company. Okay. Um, but to be reported as a liability, an obligation need not be payable in cash. Okay, so that's a good thing to remember. Instead, it can require the company to transfer other types of assets, okay, or maybe to provide a service, okay, and that's going to be the remuneration for the product or the service. Um, a liability does not have to be represented with a written agreement. Okay, in corporate we called these trade payables, is what we referred to them as. They don't have to be legally enforceable. So it's not a some you don't always have a contract with everything. Okay. But it does tell you there that the characteristics of a liability are that it's probable and it is the future sacrifice of economic benefits. All that means is the company's going to have to give up cash or provide a service. They're going to have to give up something in order to satisfy that debt because a liability is a debt. It does arise from present obligations, okay? So it's a transfer of assets or providing services. And it results from past transactions or events, okay? Um, so it's a present responsibility to sacrifice assets in the future because of a transaction or some event that happened in the past, okay? So that's kind of the best way to think about it, I guess. So like we've talked about, we separate our current liabilities from our non-current liabilities, okay? And so in a classified balance sheet, you're going to see that separation on the balance sheet. So a lot of time, so most of the time, the obligations that are payable within 1 year from the balance sheet date, or within the firm's operating cycle, whatever that may be, these are your current liabilities. Okay. And so these are things that are expected to be satisfied within a year. Okay. Um, and the reason, another thing that we separate it is because, and we talked briefly about this the other day, but it helps your investors and creditors know, um, you know, are they going to have to give up cash or the payment for this in the next 12 months? Or do they have longer? And so that's why we separate it so that we can, keep an eye on our working capital, know what's going on with that. Okay. When we record liabilities, and this is really important for those of you who want to, move on with the CPA and all that good stuff, we always record liabilities at their present value. Now we talked about time value of money in 301. Remember, we talked about how when we go forward, we oh my Lord, the word just left. We compound. It just left me. When we move forward, we compound, but when we move back to present value, we discount. Okay, so you're going to see some of that come into play in this chapter, and I'll help you with that. So, because I know you've probably forgotten everything you did before Christmas, right? It's okay. And so, but liabilities that are payable within a year are usually, you go ahead and record them at their maturity amount. And we're going to look at some examples of those so that it will make sense to you. Okay. Some examples of liabilities, and like I said the other day, most of your liability accounts end in the word payable, and you can see that here. Accounts payable, notes payable. Usually you'll have an income tax payable account, dividends payable, your accrued liabilities, and usually with accrued liabilities, we actually have like utility payable or gas payable or something like that. The one that doesn't is that unearned revenue that we talked about the other day. Okay, so that's also a liability. Okay, so um, getting into, let's see what we got here. Getting into accounts payable. We know that accounts payable are obligations to suppliers or, of merchandise or services that we're going to provide on an open account. So most trade credit, remember I called it trade payables a while ago, that's offered on an open account. So that means that only the formal credit interest instrument is the invoice. Okay, so you purchase something like, let's say Lander. Let's look at Lander. Lander, let's say they purchase. Let's see, what does Lander purchase? Well, they purchase copier paper for the copiers throughout the college, the university, right? And so they probably have an agreement, where they get, because they buy in bulk, so they get a good discount for buying in bulk. And so when they buy that, okay, they don't have to sign a form or anything like that, but the supplier, whether it's, I know y'all don't have a Staples in Greenwood, so probably like Office Depot, when they deliver that, okay, there's really nothing. Somebody may sign that it was received, but what happens is Office Depot or whoever provided the paper will send an invoice to Lander University, okay, and so, but that means it's just a trade payable. And are they going to wait more than a year to get paid for that paper? No, that's a current liability. Okay, so that's going to go in the current liability section of the financial of the balance sheet. Okay. Usually they're 30, 45, or 60 days. It just depends on your company and what you feel like, what kind of terms you can give your folks. When I worked in industry, for accounts receivable, we expected our customers that bought on credit to pay us in 30 days. I paid my accounts payable, my vendors, in 45 days. So you see, I was letting the customer pay their bill, which gave me the cash flow that I needed to pay for what I had to buy to provide that service or that product. So if you're ever running short, if you're in corporate and working and you're ever have a cash flow shortage, that's what you need to check. One of the first things to check is look at your credit policy with your customers. How long are you giving them to pay, and are they paying? and then look at your payables, because if you've got your payables, due in 30 days and you're giving your customers 60 days to pay, then yeah, you're going to run short on some cash. So that's just a good place to look and to be aware of, and to run your business, okay, and be a good accountant, okay, and that's what I want for you. Your book uses a little bit different terminology than I did in corporate. They call trade notes payable things that are more formal, or whatever. But again, it's, wherever you work is going to have their own thing. I just always considered my accounts payable to be um, trade payables. So, but just the main thing to take away from this is to understand the difference between current and non-current. Okay. All right, so let's talk a little bit about notes payable. So we know that notes payable comes from, financing. Okay, so we know that liability is debt. Okay, and so when we're looking at short-term notes payable, this is normally how a company runs, like with the Office Depot. It's a short-term payable. It's not necessarily, you don't have to go to the bank and borrow money. But here in this slide, it is talking about a relationship with the bank. Okay. A lot of bank loans are short term, and sometimes they're renewed. They're just renewed and renewed and renewed. And then there are longer term ones. So it just kind of shows you here, that there is a promissory note that is signed, and that has interest. You pay interest. See, normally, like on the Office Depot scenario, you don't pay interest. They just bill you for whatever the paper costs. Now, if you're late, they may charge you a finance charge, okay? But with what we're looking at right here, this is like a loan at the bank that's a year or less, okay? But you do pay interest on it, okay? So you would show this separate from your, paying your utility bill or your vendor. This is a little bit more involved, and a lot of these are more formal, okay? So you do have a written agreement. You can do this with unsecured loans, credit lines, secured loans, and commercial paper, okay? So just kind of giving you, okay, so credit lines, talked about that. I remember years ago when the banks would give people credit lines. I don't know if they still do that or not. And if you borrowed from it, you would make payments on it and pay it back and all that good stuff. I don't do any of that with banks now, but typically a short-term bank loan can be done by extending the customer a line of credit. Okay, so it's always good to have a good relationship with your bank. Okay, because that's what it's for. It's to provide the company with short-term financing. That you don't have to go through this rigmarole. Of signing papers and everything. It's there for you. If you need it, you take it, and then there's of course guidelines for when you pay it back. Okay. It talks here a little bit about committed and non-committed. One's a formal agreement, one's an informal agreement. So it's just up to you and your bank how you plan to deal with that, or what your bank offers you. And so that's something you'll want to look at if you're shopping for a bank for your company to use, or maybe you're not happy with the bank your company's currently using and you want to shop around. These are some of the things that you would want to look at to see if they're available options for your company. Okay. The company is required by GAAP to disclose credit lines that they may have. And you may wonder why. What if they have a credit line and they never use it? Well, the point is they have the ability to use it, okay? And so the creditors and the investors, people that are using the financial statements, they need to know that this is a possible liability that may occur with this company, okay? And so here it's telling us this was IBM. And they said they extended the maturity date on a 5-year credit agreement by 1 year. And so they're just telling you that. But even your investors and creditors need to know that that's a possibility. Okay, especially if it's like an open line of credit. Okay. All right, so interest, good old interest. So this is kind of important as well. So when a company does borrow money, okay, and these are like your notes payable, and it can be short term or it can be non-current, it could be a long-term loan, okay? But the company has to pay the lender in return, we pay interest in return for using the company's or using the bank's money or whoever the lender is. You kind of think you can kind of think your book tells you to think of the interest as rent. You're paying rent for the money that you borrowed. So I thought that was kind of interesting. Um, but interest is stated in terms of a percentage rate to be applied to the face amount of the loan. So that makes it an interest bearing loan. Okay. The stated rate is typically an annual rate. So anytime you're looking at a homework problem or reading, when you see the rate listed there, that is typically the annual rate, okay? But when we're calculating interest for a short-term loan, okay, maybe a 9-month or a 6-month loan, then we have to kind of fraction that up a little bit. But the formula that you need to remember for calculating interest is just the face amount times the annual rate, okay? And then you multiply that times however long the loan is, okay? So, and that time to maturity, it could be 3 months, 6 months, 9 months, a year. I mean, it could be 5 years, but that's your basic formula no matter what you're doing, okay? So we'll look at a couple of examples before I let you go today. This is a note issued for cash. So this is just that you go affiliated, who is an electronics firm. They borrowed $700,000 from First Bank Corp, their bank, under a non-committed short-term line of credit arrangement. In return, they issued a 6-month, 12% promissory note. Okay, interest is payable at maturity. Okay, so all of that information is important. So, do we have the three elements that we need in order to determine what this is going to cost? Yes, we do. And so we can actually we take the face amount of 700,000, we multiply that times that annual amount, which is 12% for 12 months for a year. But notice the line of credit, the borrowing is only it's due and payable in full in 6 months. So we don't want to charge a whole. So if we were to say 700,000 times 12%, that would be what, $84,000 in interest. But we're not going to have the loan for an entire year. So that time to maturity is we take that year and we divide it by however many months that loan is. And since it's 6 months, we take the 700,000 times 12 times 6 divided by 12, which is, of course, since it's 6 months, it's half of the 84, which is $42,000. Okay, so it's a pretty straightforward calculation. Don't overthink it. You can, real quick, like in your calculator, if you want to just, check it, make sure you understand how to use the fraction, the 6 divided by 12. And so when you go to record that on May 1st, of course, you will debit your cash and you create the liability through notes payable. So that's the entry that's made at the time the loan is incurred. And then when it's due 6 months later, okay, then you're going to clear out that notes payable. Remember, payable, that's a clearing account, so it's always zeroed out. So you're going to credit or debit it the 700,000. But you've got to write a check to include the interest. So you calculated that interest, it was 42,000. So when you record that, you have to record the check you're writing to pay it back as a credit of 742,000 that's coming out of your bank account. So what do you do with the 42,000? You show that as interest expense. Okay? So that's a debit to your interest account. Okay? Now, so this is kind of where I don't think your book actually goes into it at this point, but I always like to point it out. You're like, okay, so that's interest expense. That's an expense that's going to reduce my net income. But there's a benefit to that, right? Because the less net income you show, the less what you pay. the less tax you pay, right? So, that's why sometimes, borrowing money is a good option for a company. Because you have that interest expense that you paid and it reduces your taxable income. But you can get to the point that it's the same with a company as it is with us. If you get to the point where you have too much liability, too much credit extended, then you're looked at as risky. And so that 12% might convert to 16 or 18% because the lender thinks you're a little bit, risky. So that's why sometimes you may decide, well, instead of financing or going to the bank, let's issue stock, okay, because there's no interest to pay with stock. So like I said, you don't walk out of the accounting class knowing the perfect scenario, what you're or what there's not one size fits all. Your job is to learn what the different options are and how they affect your financials, okay? So again, this looks like a really simple exercise, but if you're a company that's having a problem, that you might need that 42,000 in interest, so you pay less taxes, okay? But then again, that might not have been a good option for you. So those are the decisions you have to make, okay? You don't make those decisions in a classroom, okay? Now, if I gave you a whole case with certain criteria and expected you could make a determination. All right, so there's also this thing called non-interest bearing notes. So what we just looked at was called an interest bearing note. And so there's also a thing called a non-interest bearing note. Now, so let's look at the big picture. Let's be realistic. Nobody's going to loan money and not expect interest, right? Okay, so yes, there's going to be interest, okay, but I'm going to show you why it's called a non-interest bearing note, okay. The reason why is the interest is deducted or discounted from the face amount to determine the cash proceeds available to the borrower, okay. So here is what actually happens. Our same company, okay, they bought inventory worth 658,000 by issuing a 700,000 non-interest bearing note. So what does that mean? Okay, what that means is the inventory was worth 658,000. You remember GAAP principles say that we have to put our assets and our liabilities, we record them at cost, and so or their value, and so we would debit our asset account the inventory 658,000. But when that time comes in 6 months to pay that back, what do we have to pay for that inventory? We have to pay $700,000. Okay, so when this goes on the books, it gets recorded at the 658 with a discount on notes payable of 42,000. The calculations are the same. I'm glad they stick with the same numbers. It's still 12% and everything. Okay. So what happens then in 6 months when it's time to pay that vendor for that inventory, of course you're going to credit cash and you're going to clear out your notes payable with the 700,000. Well, now you're going to debit interest expense, okay, just like we did in the other scenario, but now we're going to credit discount on notes payable, okay? And there are reasons to do it this way. I don't think you see it too often, but it does happen. Let's look. Let's see. I think we've got an example. We'll walk through and just kind of look at that. Some interest. Let's see. Sometimes interest in such arrangements is described by referring to a discount rate that's applied to the face amount of the note. So in our scenario, the 6-month non-interest bearing note would be described as being discounted at issuance at 12% discount rate. So remember I told you the numbers are all the same. So the amount borrowed under this arrangement is only 658, but the interest, what's got to be paid back, is the 700,000. Okay, so this kind of affects the effective interest rate. So that's a new term for you. It's one you want to be cognizant of. Okay, make a note of it. I think I probably have a homework question in there about it. So, how do we calculate? We know that the 12% is the annual interest rate. How do we calculate the effective interest rate? Okay, so if we take the 42,000, which is the interest for the 6 months, and we divide it by the value of what we borrowed, which is the 658, then we find out that for 6 months, that's 6.38% for 6 months. So when we take that and we multiply that by the 12 divided by 6, then that gives us the 12.76 effective interest rate. So basically, what you've got in this scenario is a 12% APR, annual percentage rate, but the effective rate is 12.76. Okay? So just kind of understand. I mean, like I said, I think I gave you a homework problem. So when the interest is discounted from the face amount of a note, the effective interest rate is higher than the stated discount rate. Okay? So just keep that in mind. Okay? Secured loans, that's basically nothing more than, having you've got to have some kind of collateral, or you've got to, what does the lender, what can they get in return if you default on the loan? There's a new term there that you probably haven't heard. It's called factoring receivables. That is done a lot these days. Okay, so think about if you have credit cards, which I hope you don't. But if you have credit cards, a lot of times when you get an account, you don't make a payment to that company. You might make a payment to Synchrony. Let's see, I've got I think my Care Credit goes. I make a payment to Synchrony. There's other companies like that too. And so what happens is the company that you've got the credit card through, okay, they have that, and you get your purchases through them, but they don't hold on to that. Home Depot, I think, is one. Lowe's is one. They don't hold on to those receivables. They sell them outright to a finance company who will be responsible for collecting that money. And so that's a whole nother lesson that we could talk about how that's done. Because of course you're like, well, then how do they determine, how do they get all their money? Because if I'm the company, the finance company, and I'm wanting to get their receivables, and I'll be responsible for collecting them, how do I know, all customers are not going to pay? So there's a negotiation that goes on between the company and the finance company as to how much they're willing to, let that finance company purchase that accounts receivable for. So, like I said, that's another whole thing. But I just want you to be aware of what factoring is. Okay. Commercial paper, basically, sometimes temporary financing by big companies is done with commercial paper. This just basically it refers to unsecured notes sold in minimum denominations of $25,000, and they can mature within 1 to 270 days, and that's why they're usually considered like a cash equivalent or something like that, because they do pretty much mature kind of quickly. Okay. Um, let's see. That's all I want to say about that. Let's see. Again, we're coming back. I told you the same thing in 301. We're going to have the same thing in 302. Disclosures are a huge thing, and I think you saw when we went through 301 how important disclosures are. So in this scenario here, we've got disclosure of notes secured by notes receivable, Deere and Company. So they put a thing of short-term securitization borrowings are secured by financing receivables. The Comcast one, our commercial paper programs provide a lower cost source of borrowing to fund our short-term working capital. And so they give, as of December 31st, amounts available under our revolving credit facilities, net of amounts outstanding, totaled 9.2 billion. So again, it's all about disclosure, okay? Because some of these are figures you won't see in the financial statements. But, you kind of need to know, okay, what is the potential that this company could borrow? It's like a open line of credit kind of thing. And so as an investor, then you kind of need to be aware of that, okay, and what the company, could possibly do. Okay. Let's see. I think. Give me just a minute here. I was trying to think. Yeah, I'll go ahead and talk about accrued liabilities, and we'll probably stop here if that's okay. So accrued liabilities, of course, are when expenses are incurred but they're not paid for yet, and that's under GAAP we have to use accrual accounting. And you've learned, and you should be very comfortable now at this point in your academic journey to know that the reason we accrue it is because, we want to get it recorded. We want to get that expense recorded in the period that it was incurred. Okay. So a lot of times you might not get your power bill until, the meter, you're on a 30-day meter or whatever. So you don't get that bill until the end of the period, and it's not usually not due until 10 or 12 days later. So you're writing the check to pay that utility bill the month after you actually incurred that expense. And see, GAAP doesn't like that. GAAP wants to see how much gas or electricity you incurred in the period that you earned sales. So if you're so in sales for a period, you need to match it up to, whatever utilities or whatever other expenses came about during that same period. And that's why we do adjusting entries. Okay, that's what adjusting entries are all about. Okay. And so a lot of times it could be salaries, like sometimes, the pay period may run through the last day of the month, but the employees don't get paid until the next week, which is in a new month. And so that week of payroll has to be accrued back to the current period. Okay. And then of course adjusting entries reverse. So when the check is written in the next month, it clears, it goes back against that payable, that accrued account, and clears it out. And a lot of times companies, they may just have an account called accrued liability. We always had separate ones. So we knew if what was payable, we knew if it was salaries or wages, we knew if it was taxes, we knew if it was interest that was coming up due. So a lot of companies prefer to keep it separate. But that's kind of like a CFO or CEO kind of decision, how they want to show that. Okay. Let's see. So, yep. So here's a good example, and we'll close with this. So on May 1st, our wonderful company affiliated borrowed $700,000 in cash from the bank under a non-committed short-term line of credit. Okay. They issued a 6-month, 12% promissory note. Okay, and interest was to be paid at maturity. So let's assume the fiscal period of Affiliated Technologies ends on June 30th. Okay, so in other words, a lot of companies have a calendar year end. So their year end is December 31st. Okay, well, this company closes their books out the middle of the year in June. Well, they got this note, this loan, on May 1st. So how many, and it's a 6-month loan. So think about it this way, kind of picture a timeline and think about, okay, if it's 6 months and it starts in May, but their year end is in June, only May and June are going to be on the year end financial statements, right? And so what happens is before you close your books, you have got to show, even though you're not paying that interest until the 6th month, you have to close your books showing that you owe 2 months worth of interest. Okay, so they're your initial issuance of the note. We debit cash, we credit notes payable, no big deal. But at the end of June, when you go to close your books, the accountant has to do an adjusting entry to show that we owe 2 months worth of interest, even though it's not going to be paid until the 6th month, okay, or 4 months into the new year. we owe this, and that liability needs to be shown on our balance sheet. Okay, so that's a good thing to learn there. So then what happens is then when the time comes when that 6 month loan is up, we're 4 months into the new year, which would be July, August, September, and October. So when we pay the note on November 1st, okay, then we've got the other 4 months of interest that we need to show interest expense. Okay, so we debit our interest expense. Well, remember in our entry at two months, we recorded interest payable at 14,000 because we knew we had to pay that in the 6 month. Well, now we're gonna clear that out. If I can get back to the right slide. Okay. So, yep. So now we're going to add the 4 months of interest. We're going to clear out that interest payable account. We credited it back in May, or back in June, I'm sorry. Now we're going to debit it. We're going to clear out our notes payable, and we're going to pay the bank the 742, which is the principal plus all of the interest for the 6 months. But you see what's happening is because you had a period, and a lot of times the company will go ahead and show the interest payable every month. They'll go ahead and make that entry because they know they've got to make it. But it's especially important if you've reached the end of the year, okay, because you want to close those books out with the right thing. Okay, so any questions about any of that? Anybody? I kind of gave us a little bit of a refresher and where we're going. Any questions from anybody? If you're not comfortable unmuting yourself and asking a question, you're welcome to type it in the chat. I'm cool with that. I'm watching it. So let's see. Looks like we had about 20 people show up, so that's good. That's good. I appreciate y'all doing this with me today. Anna, do you have a question? Nope.
No.
Okay. You appeared. Everybody else is black and white, and I've got your face. Yay. Um, let's see. Except for Andrew. Andrew has a pretty A on his. So anyway, but again, I apologize for the inconvenience of this today. Hopefully, we're going to get this resolved, and we're waiting to talk with the insurance company and everything. And just glad everybody made it out okay. Oh, let's see. Amara, can you restate what a non-interest bearing note is? So, absolutely. So, a non-interest bearing note is one where it's all about how it's recorded because, like I said, every note has interest. No bank is going to loan or finance company is going to make a loan and not charge you interest. What is different is how you record it. So, imagine with that scenario that we had, it was that we bought inventory that was valued at $658,000. Okay, so just imagine that you went to the bank and you said, "Okay, I need to borrow $658,000." And they give you the cash, but you have an agreement with them that you're going to pay them 12% interest for 6 months, right? And so when you go to record that, you only receive the 658,000. Okay, so that's what you put for your cash or your inventory, but your agreement with them is that you'll pay them 700,000. So you have to show that as a discount on notes payable, which is what that journal entry showed. Okay, so it's not that it's not doesn't have interest. It's all in how you show it in your books, how it's recorded, and that's why it's so important in accounting that we understand that difference. Okay, so yeah. So does that help, Amara? Okay, yeah. It's okay. Sometimes it helps to hear something a little bit different way. But that's a great question because you're like, yeah, I mean, every loan has interest, so why is it calling it a non-interest bearing? Okay, but that's why, because all that got recorded up front was what you received. Okay, whether it was 658,000 in cash or 658,000 in inventory, but you're agreeing to pay, so you have to set your payable up as the full amount, what you're going to pay back, what you're responsible, your true liability. And so that's why we hit that discount account for the difference. Great question. I love it. I love it. Okay. Anybody else? All right. Well, we didn't do too bad today. Again, I appreciate y'all meeting with me this way. Hopefully things will be kind of calm down. I know they won't be, they're probably going to be here for a while, so that's okay too. But anyway, I should be back on campus next week with no problem. And I'm gonna, this was recorded, so I'll just put it out there somewhere. I'll probably create a video folder or Zoom folder or something like that, but I'll do an announcement, especially for those who couldn't be here. Remember, if you're on with somebody, I don't see their name, I just see your name. So, whoever's account you're on, so just shoot me an email if you are on with somebody so I'll know. All right, guys. I hope y'all have. Oh, this is a holiday weekend in it, so you got a long weekend. All right. So y'all get some good rest. Enjoy Monday. No school Monday, and I'll be seeing you on Tuesday. But please do reach out to me if you need any assistance. Let me check my chat. Okay, that's it. We got the chat done. All right. Just reach out to me if you need any assistance with anything. Okay. And I hope your term is getting off. Your semester's getting off to a really good start. I really do. See you later. Bye bye.
Thank you. Bye.
Uh huh. Bye bye.